Welcome to the March 21st, 2017 edition of On the Call, a service of Zacks Institutional Services. And for those of you who are new to our calls, this is a live conference call featuring Zacks strategists providing their analysis of the latest issues and trends affecting investors, including but not limited to the market and the economy, both globally and here in the U.S. Today, our Chief Equity Strategist, John Blank, is back with us, and Tim Nyland, Managing Director of Zacks Institutional Services Division. They're going to be our two panelists. John's going to be talking about something you don't hear discussed very often, politics and political management style as potential market catalysts. Then Tim's going to follow up with how the market may react to either the success or failure of these catalysts. So John, as always, we start with you for the background. You're going to delve into this very interesting market driver, huh?
Yeah, thanks, Terry, for that introduction. Yeah, for everybody's purposes, make sure you understand today that I'm going to cross on some pretty trepidatious ground, and I apologize if I offend anybody in advance. It's not my intent. My intent here is to try to be the guy to deal with the difficult subjects that are at hand. So they're only my views. They're not Zacks' views, and they're certainly not my colleagues' views. So keep that in mind. What I'll do is I'll go through my 4 points. A theory of political misbehavior. Number 1, base-driven and objective-driven politics. Number 2, the idea that GDP growth is a netting device for our national politics at the moment. And number 4, how does this end? And so for all of you, and to tie into Tim's slides at the end, I'll try to touch 3 things in each of the 4 sections. One is just the government or governments, how government matters for this behavior. That's a subject unto itself. It turns out that the 3 things I'm interested in, government and governments, GDP growth and revenue growth and earnings growth is another second subject, and the stock market. The truth is, and this is my main point that I will make to start through my slides, is that government, GDP growth, and stock markets are 3 separate subjects, and there really is not a karmic reality, meaning you don't have bad government and it takes you down a recession. You don't have stock markets judge the government. These are 3 very different variables. They can't all go up together. They can't all go down together. But the truth is, only when GDP growth goes negative will stocks react, and as long as GDP growth is modest and somewhat positive, the stock market can wander wherever it wants to, and the government, being only 15% of GDP growth, spending-wise and taxes-wise, being the flip side of that in an accounting identity, is just not enough of the story for the economy. We got to remember that 85% of the economy is not involved with the government, 85%, and that explains why they kind of wander off in different directions. So let's go ahead and go to my first slide. Slide number 4. All right, so the way I'm going to deal with this is through this book that was written by Aaron James. Now notice that this book was written in 2012, and it was published by Penguin Random House, and it won a New York Times bestseller. Now why I brought this book to your attention is a friend of mine in Boston put it to my attention. He's, by the way, a really brilliant guy, went to Harvard and all these things. And so Aaron James himself got a PhD in Harvard. And the way to think about Aaron James and me is when I was at MIT getting my doctorate in economics, what I learned was the top political science profession also was located in the same building at MIT. MIT actually has a top-ranked, 1 or 2 top-ranked political science group. So I was exposed to this type of stuff during that time. And this book, taking the title for what it's worth, is about the political, psychological, sociological significance of this situation that includes this president. It was written, by the way, 5 years ago when he was a property developer, not now, and it's addressing this very, very interesting subject. But what I want to tell you is, and why I'm asking you to read this book, is I can't, in good conscience, give you an answer to what the effects of this type of person will have on this economy. It's unlikely to be the right story, and I really think you should read this book. So I'm told by anybody who reads this book that it's outstanding. It's not a long book. and it's great. And when it was written, when this gentleman was at a Burkhardt Fellowship at the Center for Advanced Study in Behavioral Sciences at Stanford. So what you're reading is the very, very top end of political science. And that's what I think I want to draw your attention to. If you want to deal with Donald Trump and the misbehavior of this government, you're going to have to go into this book and read it. And so that's pretty much where I'm going to go. Let's go on to 6 and 7 and 8. 6, first of all, we'll just point out that MacArthur and Stanley McChrystal, U.S. Army generals, really kind of set the tone for this type of behavior. It's not new. Let's go to the next one. That basically Simon Cole, Mel Gibson, Hugo Chavez, Mahmoud Ahmadinejad, and Silvio Berlusconi, all these people share the same personality with Donald Trump. So there actually is no U.S.-specific element to this. This is a national international problem. Let's go to the next one. Let's go to the next one. And this is what I want to focus on. This is the only thing that really should draw your attention to this book, is that people like this have 3 characteristics. And these 3 characteristics are the critical things about thinking about this president. 1, he will allow himself to enjoy special advantages, and he will do so systematically, meaning it will not change going forward for the next 4 years. He will do this out of an entrenched sense of entitlement, and he will be immunized by his sense of entitlement against the complaints of other people. So the point is, do not expect this president to change. Do not expect any complaints that are thrown his way to matter. This is the course of this type of person. They are not going to change. That's my main point. Let's go to slide 15. All right, the next thing we have to deal with is base-driven versus objective-driven politics. Base-driven versus objective-driven politics is a concept and a piece of language that I want to put into play here. So what we have here is a timeline of base-driven politics. And I started it with the pre-existing Republicans, which are Bush, Romney, McCain, Lindsey Graham. By the way, all these people are very old, very old. And then along came this further right group, which we're now dealing with, that started with Newt Gingrich, went to the Tea Party, and now is with Donald Trump, who, by the way, is the oldest president in history. Now, if you look on the other side of the aisle, you have Bill Clinton and Hillary Clinton, and then further left, the not Clinton crowd, you had Bernie Sanders. All of these people are old. So my main point about bringing this slide to you is not to pay attention to Republican or Democratic words here, but to realize 2 things. One is the base is very fractured now. We have 2 sides to the right and 2 sides to the left. It's actually a 4-party system. And the other is all 4 groups are run by someone who's very old. So today I saw that ages 18 to 30 have a 22% approval rating of this president. So my main point is this is a very old government running in a very new economy. And my belief is sooner or later what's really going to happen is this is the end of the old era and there's going to be a new era. This is going to bring a new era and new younger people into the government. I'm not saying in a year, not even 2, but by 4 years from now I'd be very surprised if younger people don't get involved in government. Let's go to the next slide. Okay, so here's an example of base-driven politics. This is an actual email. You can read it yourself. This came to me from the White House itself on March the 13th. And what it said was, just this top line, Obamacare has been a complete failure since the beginning and things are only getting worse. Now, inclusive politics, meaning running for the whole country and all the people in it, wouldn't target this type of language and send it out. So what it means by the base is this president with his tweets and all this type of stuff is targeting his own base. He is only interested in communicating with his base and keeping it behind him. So one of the key pieces of information about this politics that we're in is it's base-driven. It's all about the base. It's not inclusive. It's about, and it will not change. So you have to expect very diverse and polar opinions based on who you are in the political spectrum with base-driven politics. That's the point of base-driven politics. You do not seek inclusivity. You seek your base. Let's go to the next slide. Now, objective-driven politics are very, very different. This is a story in Paris, and Paris, France is what I'm talking about. And what I'm talking about is a big building project, infrastructure project in Paris. that was put together by a very young bureaucrat with information centered and bolded around young. Houseman was his name, and he was the one who built Paris up to what we know with the boulevards. My point is, objective-driven politics, when I've gotten involved in it, is about something specific, physical, and you're trying to achieve something. You don't care about the base, you care about the objective. So this is a very different idea. So let's go to the next slide. Okay, so I got involved with trying to turn around the manufacturing cluster in Los Angeles. And if you go to the next slide, I'll tell you a little more about what happened. I first started out working for Mayor Villaraigosa, and we got the apparel manufacturing industry turned around. I was objective driven. I was driven by getting the jobs up, getting the output up, turning that industry around. And as soon as we got it turned around, a lefty government came into place, passed the $15 minimum wage, and that was a setback. And so this is what happens. Base-driven politics and objective-driven politics net each other out, and now we have immigration restrictions, which are also working against my original plan to turn the apparel manufacturing industry around. So I can't do right with politicians even when I'm trying to achieve objectives. And so the point of this is GDP growth. We're seeing such weak GDP growth the last 7 or 8 years. Part of it is this base-driven politics just whittling away at objective-driven politics, and that we keep getting the net of our politics in this country, whether it's right or left, and that base-driven politics is eating away the growth rate. And that's been my experience. I did try to turn around manufacturing for 5 years, and it didn't matter. Every time I turned up the heat and got the thing pointed and get all the arrows pointed in the right direction, someone reversed an arrow on me and took some of the growth away, and that's what we're seeing at the national level too. So let's go on to slide 21. Okay, the other thing I want to talk about is, well, let's go to 20 actually, one up before that. Centralization versus decentralization. This is another way to keep your eyes on, because one of the problems and one of the things that gets people too pessimistic is they care too much about what happens at the center, basically the presidency. And my point is, don't be too worried about the center. You can overemphasize the case of the center. There are plenty, markets and prices. There are things that happen in the apparel industry and nobody saw coming, like social media, demand growth, advanced manufacturing industry. There are state and local governments, and there are always the pushback from abroad. So there are just loads of governments and loads of private actors out there that matter a ton more than the center. And that's something to keep in mind with. That's the optimism that I have, is decentralization matters far more than centralization in this whole thing. Let's go to the next one. All right, so the main thing I want to point out is right now, in the first quarter, we're doing about a 1.2% growth rate in GDP. That is not anything to be respectful of. That's pretty crummy and pretty lame. So let's go to the next slide after this to make a case. Let's go to the next slide after that. Okay, let's talk about, again, some of the unintended consequences of this administration as they apply to growth. We've heard about the Muslim travel ban, or now it was knocked down, but the basic idea is here you have a policy of the president to build growth, and it's led to a slowdown in travel to the United States, particularly amongst Europeans. So another one to look at infrastructure. We're going to build the infrastructure plan. That's a big one. We're going to build the wall. That's another big one. But if you net out the two, what you learn is that the wall being higher and the wall being constructed will create more money for drug gangs that can smuggle people into the country. And if you build infrastructure, you're going to need construction workers, which is going to raise the demand for Mexican labor. At the same time, you're going to raise the wall. So they're working against each other. So what I would warn people of is all this optimism about the president's policies has not incorporated unintended consequences. It's very unlikely to get us anywhere. I don't think it'll get us into a recession, but I certainly don't think it's going to get us any growth. And that's my point here. When you look at this government, it's the government, and the conduct of this government is more of a long-term thing than a short-term thing. It's unlikely to change. When you look at GDP growth, net in the unintended consequences. If you net in GDP growth, you're not likely to see growth. You're not likely to see 3%. And then the stock market. We all know the stock market is booming. Well, the bottom line with the stock market is the stock market can do whatever it wants. The truth is the NASDAQ has been moving more than the S&P, and that tells you tech stocks and the international stocks that are exposed internationally to demand internationally are really the source of growth right now. And we really don't know what the market thinks of this president. It's a little too early. Obviously, there's been some Republican optimism. Obviously, the small business indicators are up. Obviously, there's been some real positive feeling towards this president, but it's not clear to me that it's sustainable, and it's not clear to me we wake up in a year from now and it could be anywhere. However, that could mean an S&P at 2,600 as well as S&P 2,000. I'm not making a call directionally on this market, but I'm telling you, GDP growth, stock markets, and government behavior are three different subjects. They rarely meet. The only time they meet is when GDP growth goes negative, then that takes stocks down. Let's go to 27. All right, here's the global facts. Here's what I want to finish with. Go back to 27. The main thing I want to talk about is the last election versus the next election. And what I've got here is the donkeys representing the base of the Republicans, the pigs representing the base of the Democrats, the chicken representing people who are kind of not voting, we're just disgusted, and the rabbits are the young people who are staying out of it. And so what you can see here is really no one was popular in the last election. There was 40% to 40%. A lot of people either stayed away or didn't vote or voted for a third-party candidate. This was a very unpopular set of candidates, and so this was what the base looked like. Now let's go to the next slide. Now, chronological time really matters, because what happens is as time goes on, and it's a grinding thing, it's not an overnight thing, but it grinds away. Older people die, younger people get older, get more savvy, and start entering the base. So bases are very hard. I mean, think about it like a restaurant. You're setting up a restaurant. It's very tough to know your bases. It's very tough to say business is a restaurant. The same is true for parties. It's very hard to say that the base we saw this time around is the same one next time, and it's very likely that the next time is going to bias itself to younger people. So let's go to the next slide. Let's go to the next slide. Now this is one thing we got to keep in mind. One of the other things that are going on, again, that's not GDP growth-wise, but there's a drug epidemic. You can see where these red marks are. This is where the Trump strength is really strong, and so we got to think again that something other than GDP and other than unemployment is keeping some of the concern in the country alive, and this is very real, and we need to appreciate that. Let's go to the next slide. Okay, so I'll finish up with this one and hand it over to Tim. My main point here is I think the younger politics, and I think this whole populist thing has already ended. I think we've already seen the top, and I think we're seeing what I'm talking about, a younger leader, more centrist politics, and a surge in interest in politics, both in the Netherlands when we saw 85% participation rates, and now we have a 39-year-old centrist candidate, Emmanuel Macron in France, who's jump-started the pushback. And this is my main point. My view long-term is Donald Trump is going to drive young people, and particularly women, into politics, and in 4 years you're going to see a totally different government. It has nothing to do with right or left wing, or Republican or Democrat. That's not my comment. My comment is youth. Younger people are going to get very concerned, get motivated, and they're going to get into the game, and that's my call long term. So my main point, leaving with to Tim before we go, is government, GDP growth, and stocks are not correlated. There's no way for us to look at anything the president has done and decide it's going to matter for stocks long term or short term. And GDP growth only matters for stocks if it goes negative. If even it goes sideways or even gets weak but stays positive, it will not matter for stocks because people can always take the outlook that it's going to turn around. And Tim, I'll let you take it from there.
John, I want to come back to one point real quick. Are those unintended consequences that you outlined, are those the black swan policy events that are lurking in the shadows?
It very much could be, Terry. Good point. Yeah, the unintended consequences do include, the rollover of this government or some type of major collapse in the stock market. I mean, you got to remember, those are two separate things. But an 18P stock market that's been rolling up the hill for 9-10 years, with rates rising, that can roll over just for that reason alone. And so again, those are very separate things, but yeah, very much clear that something can happen in this environment that's off the charts. But it's not clear, Terry, with black swans this time around that it will take the markets down. It's just not clear that all these things will will work within their own orbits, basically.
Okay, thanks. Tim, we're going to turn over to you now. Overall, market's been pretty stoic here with this rally. Optimism abounds, but yet John says what he's talking about has no correlation to the stock market. What say you?
Well, I will say that investors have become very in pursuit of adding risk in the form of equity exposure to their portfolios. So without giving too many opinions, I'd rather stick to facts. Shiraz, John, and I, we've all stated on prior calls over the past 12 months, for those of you that have been on these calls religiously each quarter, that 2000 would represent some easy comps in terms of growth because of a sluggish 2015, 2016 that we've had. So, you know, a lot of the growth that you're hearing about in terms of S&P earnings, it's baked in. We've known this was coming. This is nothing new. So what I want to do is I want to focus on not necessarily the growth itself in aggregate, but let's specifically look at where the growth is coming from, and then let's couple that with the trends in the underlying forecast revisions. And I think that when you look at this, I've put together a series of slides here that are very, very powerful. I think you'll be shocked at what we find. So I want to start out by saying that, you know, everybody really needs to be critical of these headlines that you're reading regarding earnings growth in the broader S&P 5. I opened up Yahoo Finance this morning and splashed across the front page. It's still out there right now. You can read all about S&P earnings growth of 10%, the tech sector up 16%, and that's basically what you get. You get these generalizations of broad-based headline earnings growth, and again, we've known about this for a year. So be critical of these headlines regarding growth, be critical of the headlines regarding valuation, be aware of the biases that are present in these broader market indices, and always, always question these generalizations. I'm seeing more and more of this as the optimism continues to increase. I see more and more of this, and failure to understand this is really, really going to hurt you, especially in the near term. So longer term, I think we're fine. Near term, we've got some things we gotta wrestle with here. So next slide, please. So what? So what if I told you that the top 20 names, or 4% of the S&P 500, represented 30% in the weight of the S&P? I know you guys have heard all this before. Traditionally, you hear of this in terms of the weight of the finance sector. We're approaching this from a different perspective this time. So this basically equates to 4% of the S&P 500 population contributing almost a third of the weight in terms of fundamental and valuation metrics. So the idea is, are you aware of these 20 names? If you're not, you should be, and I've got them in this slide deck. Knowing this, would you trust the reported market-weighted metrics without comparing those same metrics to their equal-weighted average equivalents? And we're going to look into these issues now, so let's hit the next slide. So here's the top 20 names by market cap in the S&P 500. Keep in mind this represents 4% of the population. It also contributes nearly 30%, or nearly a third of the weight of the valuation and fundamental metrics that you guys see reported in the press. Next slide. So it gets better. What if I told you that of those same top 20 names, the tech and energy sector represents 50% of that weight, right? So remember these stats. It's going to be very, very important. So how does this change our look at fundamental growth? How does this change our look at valuation metrics? It changes it. Let's go to the next slide. So let's first take a look at this cap bias in regards to FY1 and FY2 EPS estimate revision trends since the election. Next slide. I want you guys to make note of the bias that's built into the weight of these top 20 names, right? The next couple slides, we're going to go through the market-weighted EPS revision trend for the S&P 500 shows positive, but yet if we strip out that cap bias, it's actually flat. So next slide, we can look at the market-weighted EPS revision. And the green box that I have drawn through that 10/31 time frame is the revision since basically the prior month end before the election. And you can see that on a market-weighted average basis, we are positive. Note that the trend from the prior year, though, if you go all the way back to the beginning of the slide, is actually negative for both FY1 and FY2. So what we've done is we've bottom-up reconstructed all of the members of the S&P 500 into a composite in the Zacks research system, and we're looking at our FY1, FY2 revision trend chart, and we're basically just drawing these conclusions. Now the interesting thing is we can take that same group and equal weight them, and we do that in the next slide, and you can see the impact of the cap bias. As a matter of fact, we do pretty much a one-for-one trade-off. In FY1, we actually are up basically 1 cent, and we're down in FY2. So you could call it a net flat for FY1, FY2 if you're looking at the F12M. The estimates as far as revisions are flat. Next slide. Now it's really going to get interesting once we start diving into each of the sectors. So let's set aside this market cap bias and see exactly what we're looking at. And what we're going to do now is we're just going to take a quick pan through each of the sectors in the S&P 500. And I want you guys to remember the energy and infotech sectors. This is going to be shocking. Next slide. Keep in mind, this is your equal weighted average EPS estimate revision, top panel FY1, bottom panel FY2. Everything's in red for a reason. Remember all the optimism in the market. Remember the rally. What have we delivered in the consumer discretionary space? Granted, policies take time to implement. I understand that. Sell side tends to be late on a lot of these revisions, but it's clearly a bust in the discretionary space on an equal weighted basis. We are down significantly. Next slide. Okay. Same thing for staples. Okay. So discretionary and staples down. Next slide. Okay, here's a positive. This is energy. This is the source of a lot of our growth in 2017 because we had such easy comps coming out of 2015 and 2016. This is to be expected, but now crude oil is back under pressure, so kind of draw your own results from here. This is the equal weighted average energy stocks estimate revision since the election. Next slide. Financials, call it a wash. Next slide. Healthcare, a bust. Next slide. Industrials, a little bit of light for FY2, but flat for FY1. Next slide. Here's the bright spot, tech sector. Next slide. Materials, negative. Next slide. Telecom, negative. Next slide. Utilities. Those are basically a wash. You're talking 1 and 2 cents between FY1, FY2, F12M is flat. Next slide. Okay. If you recall, only 2 of those sectors are contributing positively for both FY1 and 2 since the election in terms of revision, right? So the idea here is that we knew we were looking at positive overall growth in earnings from in 2017 based on those low comps we had in 2015, 2016. This was baked into equity valuations long ago. Now we're looking at the estimate revisions and some of these policies that have been put into place and how the sell side is responding. We're not seeing anything come into fruition just yet. Recall that both of those sectors, the infotech sector and energy sector, represent a weight of 48% of those top 20 names in the S&P 500. Okay? So the idea here is that those positive EPS estimate revisions in those 2 sectors more than offset the declines of all other sectors combined to post positive estimate revision trend in the broader market. So we've got a very narrow portion of the market that's actually participating in positive estimate revisions, and this is key. Next slide. So the idea is now, what would it look like if we stripped out all of the energy and info tech stocks out of the S&P 500 and stripped the cap bias out? So we equal weight this group. We can take a look at what that looks like. Next slide. Okay. So again, the red box in the middle, that's the 10/31 date, the most recent month end prior to the election. Estimate revision trend negative. It's actually down 5.34% Since a year ago, March on FY1, it's actually down negative 4% from March of 2016. Notice that the EPS revision negative is actually accelerated in the January, February months. So that's post-election. Next slide. Okay. So if you're still not convinced there's an issue with the broader market generalizations being made, for many of you that have been on strategy sessions with me individually, you'll note that I tend to speak very highly in terms of the Zacks earnings certain proxy and a lot of the gut checks and great things that we can learn from this group of stocks. So surely if there is positive EPS revision trend in the broader market, this group of market-leading earnings stable stocks will show positive EPS revision trend just like the broader S&P. So let's see if that's true. Next slide. There's what it looks like long term. You can see how rock solid that portfolio's earnings are. It's a 75 stock portfolio of the most earnings stable stocks in the market. That orange line that you see is the trailing 4 quarters operating earnings line, and you can see how stable it is relative to price. Next slide. Here's the sad part. Since the election, that group is also down negative, okay, and negative from a year ago. Next slide. So what's driving this market rally? If EPS, the lifeblood of equity valuation, is being revised negatively, why are we notching these gains on a daily basis? That's what we really got to wrestle with. Next slide. It can be summed up really in one word. I call it hope, optimism, however you want to say it. You know that. But let's look at the implications of this. Next slide. Okay. This is really, really critical, right? Because in the absence of positive EPS estimate revision trend, and keep in mind, I model the market every single day. Specifically, I do it once a week in detail to calculate our own equity risk premium at Zacks. It's all forecast-based. It's all driven by estimates. And the idea here is that this hope and this optimism, in the absence of all of this EPS estimate revision trend that's actually been negative for my market basket, anything you look at on an equal weighted basis is basically going to be flat to negative, has translated into a precipitous, what I call a precipitous decline in equity risk premium that has really led to this rapid multiple expansion. And so this chart, you're actually looking at, again, for those who have been on strategy sessions with me, you've seen this before, I'm looking at equity risk premium correlation to forward multiples since the election and the correlation of that. We're looking at an R squared of basically 0.9 correlated at negative 0.94. There's huge statistical significance here. It's almost perfectly inverse correlated. So the idea is, in the absence of this positive EPS estimate revision trend, the only way we're going to absorb this multiple expansion at such a rapid pace is through a really, really rapid decline in equity risk premium. And this is really, really important when we look at the risks in the market, which is what we're going to do now. So let's go to the next slide. Okay. Really important here as well to take a look at this longer term, what the components of the total equity discount rate actually look like from a trend perspective since 2012. And the takeaway from this slide is I want everybody to focus on that red box, and I want everybody to focus on that line that I've drawn through the very tail end of that total equity discount rate at the bottom. Remember that equity risk premium plus a risk-free rate totals up to the total equity discount rate that's evenly applied to equities. That's the macro equity discount rate. You can add individual company-specific risk adjustment factors to that discount rate for individual modeling, but from a macro perspective, that total equity discount rate is the sum of those two above. The idea is you'll see that aqua blue line on a vertical. That is the point of the election, right? So everything pretty much post that date is what's happened since the election. Take a look at the decline in equity risk premium. Take a look at the rise in the 10-year. Next slide. Okay. The important thing again to note, I'm just giving you guys the evidence here, that the equity risk premium completely absorbed that increase in the 10-year treasury. Really, really important. Next slide. Okay. The decline in equity risk premium actually more than offset the increase in the 10-year. Okay, this really fueled that multiple expansion that we're looking at. And this chart shows that PE multiple relative to its own history, that multiple expansion relative to that most recent dip in, it looks like I've got the total equity discount right here. So the idea here is that total equity discount rate continuing to decline tells us that that equity risk premium more than offset the rise in the 10-year, and that's really, really important. We'll talk about that more here in just a minute. Next slide. Okay. This chart shows the entire trend back to 1975, and I've actually got median lines drawn through that. Very important. You'll see the median of the equity risk premium sitting at about 3.43. You'll see the median 10-year at about 6%. And what I want everybody to see is that really, really rapid decline in total equity discount rate right there at the very end since the election. That is, again, coupled with equity risk premium declines, what driven this multiple expansion. Next slide. Okay. So how do you make sense of all this, right? I've just shown you a lot of charts. Many of you are probably confused. I'll sum it up for you very, very easily. And you guys will all have a copy of this deck to refer to. And I've literally put almost everything that I'm saying in the deck so that you guys can follow back through this on your own. And you can always reach out to me with questions after this call. So because equity valuations have reflated in the face of flat to declining overall EPS estimate revision trends, right? That is what's given us this more than offset of the 10-year and the equity risk premium. The yield on the 10-year treasury, this is really important, is the risk-free rate. It currently is being suppressed by Draghi's ECB stimulus and the Bank of Japan running negative real rates. And this is really causing overseas demand for our treasuries. Equity risk premium, in light of both of those bullet points above, is really the only thing left to absorb the slack in the bond market. This is super important because equity risk premium is a very critical buffer for us equity investors. Okay? What's happened now, and I've mentioned this before, is that the total equity discount rates are being pushed to historic lows as a result. This is causing the equity valuations to soar. So I'm kind of bringing this now full circle. And what we're going to do now is we're going to focus on that equity risk statement. Equity risk premium is left to absorb the slack in the bond market. So let's go to the next slide. Okay. Why is this important? Because equity risk premium can actually indicate to what extent equity valuations can continue to expand in the face of a rising interest rate environment. So I want to take a full circle back to a statement that John Blank made earlier, said he did not know if the S&P was going to go to 2,600 or if it was going to go to 2,000 near term. I don't know the answer to that either. But what I can do using the Zacks research system and looking at these charts is we can go through and we can determine if stocks are basically supported by current levels of interest rate and current levels of equity risk premium. And as a matter of fact, they are, okay, supported by current interest rate levels and current equity risk premiums. Next slide. I wrote a paper back, and it's dated right here. This is what it looks like when you actually receive it. Adam Cohen will be emailing it out to everyone after this call. You'll receive it. It's dated 11/9/2012. Talk about the entire generational study of equity risk premium and inflation. Everything that I say in that paper and all the predictions I've made are basically have come true to fruition. I encourage you guys to read this document. It's phenomenal, and more than happy to discuss any part of that with anybody individually. Next slide. Okay. So the tail of the tape here is that we looked at equity risk premium relative to the 10-year, and we did it since 1975 on a prior slide. In this slide, we're doing the same thing, but I've actually taken the total equity discount rate off, and we're just going to focus on equity risk premium in the 10-year for a minute, because I want everybody to see what's going on. And those predictions that I made back in 2012 about equity risk premium continuing to decline have come true. And I'm saying that equity risk premium is going to continue to decline. It's still going to come true, and my forecast still holds for that. What does this mean, and where is the inflection point? That median trend that you see up there, that red line drawn through that chart, sits at 3.43%. Okay? it is going to be, based on current interest rates, we are looking at an inflection point of somewhere between 3 and 3.5%. I'm calling 3.5% right now. We got to see how rapidly that 10-year ends up rising. A lot of it's going to depend upon Bank of Japan, ECB, and if Trump is successful with this tax reform as to what happens here in the Treasury market. So what we're looking at is equity risk premium can continue to absorb interest rate increases for about another, I would say, 1.5%. So until equity risk premium gets down to about 3.5%, we're in the clear as far as being able to absorb interest rate increases. So keep your eyes on that. On this particular chart here, keep your eyes on equity risk premium. Next slide. Okay. So I keep close pulse on the press. I read the Journal every day. I keep abreast of CNBC. It's everything that you guys are watching. Last week, this Bill Gross interview was splashed all over every website, and it got a lot of play. And he said that this could cause hell to break loose in the global bond market. And I want to take and look at Bill Gross's statement and then take it a little bit further and talk about what it means for equity investors and what it means for us. This basically was his discussion about the monetary policy in Europe and Japan causing the international investors to buy U.S. Treasuries. So the next question I have, next slide please, is he correct? And my idea is absolutely he's correct, obviously. But there's a lot more to the story here than what's going on, right? Because equity risk premium, we know, is really quickly losing its ability to absorb further increases in that 10-year, right? That's our barometer. The real interesting part of this whole scenario is that if Trump fails to get the tax plan implemented by August, right? He's tweeted this, he's promised it. I mean, it's what the market's banking on. If that doesn't happen, or the market gets a whiff that it's not going to happen, or it's going to be delayed, or I mean, Reagan wasn't able to do any tax reform, I think, until his second term. So, if the Republicans and others can't agree on what's going on with healthcare, I'm not sure what's going to happen with this tax plan. But let's just say, for instance, there is some delay. It's going to trigger a sell-off in equities that's going to trigger capital flows back into fixed income. But this is going to happen potentially at the same time that the ECB is planning on tapering. And so those same capital flows that would be coming into fixed income in our market may end up going overseas, back into overseas bond markets. So there's going to be potentially this huge tug of war. The important point here, next slide, is that remember that we don't really have underlying EPS estimate revision growth. And in the face of those stagnant earnings revisions, equity risk premium is really going to be what's left to absorb this volatility. So what John Blank said is absolutely correct. He doesn't know whether this thing's going to go to 2,600 or 2,000. I don't know where it's going either, but when it does, it's going to go quick. It's like a rubber band that's being stretched right now. We've got a market that's, you could argue, fully valued based on everything that's expected out of this administration. And if things don't happen, we know that based on those correlation statistics that I presented earlier between equity risk premium and the broad market PEs, tell us that if we continue to hold EPS estimate revisions constant, in other words, let's say they don't get revised negative anymore, let's just say they stay flat, okay? You can expect to give back almost 90% of that post-election rally if Trump doesn't succeed at making some material progress on all these promises he's made. The market will hold him to this, right? We've seen this before. I mean, the market is not patient. The market has zero patience for this. So, next slide. So the conclusion here is not to chase this rally. To be skeptical of anyone who thinks they know where this market is heading near term. No one really knows where this market is heading. Watch the equity risk premium and the 10-year as your barometers. Those are going to trend, as I've called it, but we may get a rapid increase in that equity risk premium that just blow equity valuations out. I mean, we may end up having a really good sell-off if that equity risk premium snaps back. And so we've really got to watch that. That's really the critical barometer. Remember, there's been no change in earnings growth delivered post-election, right? This entire rally is a PE multiple expansion driven by a decline in equity risk premium. And that equity risk premium is going to lose its luster as a buffer against that rising 10-year when it reaches that 3.5% level. Now, equity risk premium, like I said, it's going to trend down over time. We may shoot back up, we might come down, we might shoot back up again, we might come back down, but over time, we are going to trend down. I don't want to be the bearer of, bad news overall. Longer term, I think we're fine. It's just short term. I think we've baked a lot of these expectations into equity valuations. I think we're a little stretched, and I think that equity risk premium, anytime you see, underlying, market characteristics change at such a rapid rate, like the 10-year and the equity risk premium, you've got to pay attention. And so I want to be here to let you guys know to pay attention. You've got the tools to do it. Just keep an eye on it. Harry, that's what I have for today.
All right, well, that about sums it up. I mean, certainly no shortage in the bad news department, Tim, but be that as it may, I guess whether we go from market madness to market sadness here at some point, it's a wait-and-see proposition, right?
That is correct. It's wait and see, and like I said, longer term, our stock's going to be higher, yes. What's going to happen near term? You see where we're at, We've got to deliver on earnings growth. How we get there, whether it's tax reform, whether it's infrastructure spending, whether it's repatriation of cash, whatever it is, the PE has expanded and E needs to rise to basically warrant current valuations longer term. We cannot continue on a multiple expansion with just equity risk premium absorbing all the slack. It just won't sustain.
Okay, once again, unfortunately, that's all we have time for this call. I want to thank our panelists, John Blank and Tim Nyland, and of course, thank you for attending. Hopefully you found this informative and some interesting takeaways here. If you have any questions regarding our services, don't forget you can always email them to zrs@zacks.com. And likewise, if you'd like to receive a copy of John's or Tim's PowerPoint presentation from today's call, the same email address applies, zrs@zacks.com, or simply contact your ZRS representative directly. In the meantime, thanks again for joining us. Feedback's always welcome, and we look forward to the next time we're all together on the call.